Welcome. You are listening to Purpose Driven Wealth, the podcast for empowered investors. If you're an investor who is tired of playing the Wall Street casinos, stay tuned. On this show, we bring on industry experts to discuss leading strategies to help you make empowered decisions with your hard-earned capital. And now, here is your host, Mo Bina.
Welcome to Purpose Driven Wealth, the podcast show for empowered investors. I'm your host, Mo Bina. Today on the show, we have Joel Friedland. Joel is a Chicago-based industrial real estate syndicator who has acquired nearly 100 industrial properties with a group of approximately 200 investors. 7 years ago, he formed his company, Brit Properties, which specializes in industrial real estate. With its affiliated company, Brit Asset Management, they own and manage 17 industrial properties in the Chicago area. Joel, welcome to the show.
Hi, Mo. Nice to see you.
Same here. It's a pleasure to have you on. Industrial real estate is one of my favorite sectors of commercial real estate, so I'm really looking forward to this discussion.
Great.
So let's start out by kind of first going over and talking about, how you first got involved in real estate and specifically in industrial real estate.
When I was a kid, I used to mow lawns. I had a lawn business starting in high school all the way through college. And I had about 60 kids working for me. It was a very entrepreneurial business. And I loved the landscaping business, but when I was in front of people's yards planting sod and cutting their bushes, what I really liked the most was looking at the houses. And when contractors would come and they'd put additions on, I'd watch them being built. And I thought, landscaping's nice, but boy, real estate would be great. I had no idea when I went to college that industrial even existed. I didn't even know what industrial real estate was. So I graduated from Michigan. The last year at Michigan, I had a landscaping business, but I decided I wasn't going into that. And I came home to Highland Park, Illinois from Ann Arbor. And I had a very close friend and I said, I want to get into real estate. He said that he had recently been in a whirlpool bath at the Covenant Club in downtown Chicago with a real estate guy whose name was Milt Podolsky. He said, now this guy is a character. He's got opinions and he's loud and he's fun. You should interview with him. So I called their office, cold called that day, and they invited me to come see them that afternoon. I ended up meeting with his son, Randy, who was about 5 years older than I was at the time, and I got hired. And I had no idea what industrial real estate was. I got thrown into it, and I ended up liking it from the first day. It is so fascinating to be inside of these various buildings that on the outside just look like boxes made of bricks or precast concrete. And inside, so many different things are done. So many different products are made and distributed. And from the first day, I couldn't believe what people were doing for a living in these buildings. So I started working there as a broker. I was a leasing broker. And Milt Podolsky told me that he had some vacancy problems. It was the recession in 1981. He said, fill them up for me. And I said, I can do that. I got 60 lawns, door-to-door canvassing. I'm going to go door-to-door canvassing in industrial parks. And I did. And I ended up making 36 leases in vacant buildings that he couldn't figure out how to lease half of them. Because I would go and knock on the door of an industrial company, and I'd walk inside and I'd say to the owner of the company, who'd inevitably be sitting somewhere near the front door in an office, hey, you want to move out of this dump? I have a place a few doors away that I'd like you to lease. And sometimes they liked the comment and sometimes they were angry. Sometimes they ended up leasing our spaces and other times they threw me out. But I became a very aggressive broker, and I think the Podolsky family liked that, and they kept giving me more and more responsibility, and I learned all about industrial.
Wow, that's a great story. And it's kind of funny you mentioned about how a lot of people look at it just like a big box or, technically geometrically speaking, a rectangle from my geometry days. And they don't know what goes on inside. They just they see people coming in and out, or maybe they see boxes and shipments and supplies going in and out, and they just don't know what's going on inside. And I think it's hard for people to kind of connect with, that as a sector of industrial real estate, or sorry, as commercial real estate. And so it's the most diverse sector of commercial, and a lot of people don't really quite understand and know about it. And so I think you kind of find out at the retail investor level as well, that a lot of retail investor level investors just prefer to invest in things, for example, like multifamily, where at some point everyone has lived, I think pretty much 99% of people have lived in an apartment at one point in their life, right? Or if they didn't, at least they knew someone who has. And so they can comprehend and kind of understand, what an apartment or a multifamily complex does and what it provides. But industrial is just such a gray area for a lot of people. And it's kind of funny that you mentioned that in the very beginning, kind of you saw that and kind of felt the same way.
Yeah, most of the industrial buildings that we deal with actually are occupied by manufacturing and assembly companies. There are other kinds of industrial, the very, very big boxes, which you see on the side of the tollway, that are the newer buildings. They're usually very attractive, big windows, big concrete panel walls. That's a relatively new type of industrial. The old type of industrial in the cities and in the close-in suburbs, they're different. They're smaller generally, and the kinds of companies that occupy them make things. They're the craziest businesses. I don't know if you know this, but do you know that restaurants don't actually own knives most of the time? They rent their knives. So there's an industrial building in Chicago where the company literally is in the business of sharpening knives and delivering them every week to the restaurants that use them. They rent them. And then at the end of the next week, they pick up the dull ones in the kitchen. They use them in the kitchen. These aren't the steak knives, but they pick up the dull knives, they deliver new knives, and they bring the dull knives back to the warehouse. The guy that runs this business has 17 different facilities around the country. It's a huge business. It's owned by a private equity group. And there are these guys sitting inside at machines sharpening knives. And there's vans lined up that go to all these different routes. Chipotle, they don't own their own knives. Morton Steakhouse, they don't own their own knives. This is just one kind of business that's out there. It's fascinating. I came home, I told my wife, I said, there's a guy who sharpens knives and rents them to restaurants? She said, no, you got to be kidding. Who would have thought?
That's so interesting you say that, because I did not know that. And what's funny is at the local farmers market that I go to, there's actually a guy who his stand, all he does is sharpen knives. So I haven't seen too many people actually walk up and have their knives sharpened, but he's there every week from as far as I can remember. And it's funny that you say that there's whole industries out there that literally are focused on just sharpening knives for restaurants.
It's crazy. One other thing, people don't know about industrial because they don't have contact with it. They do know about apartments, they do know about stores, but industrial buildings, generally speaking, are in little pockets behind the stores, behind the shopping centers, and behind the residential complexes. We don't need identity because most companies that distribute and manufacture products don't deal with the public. So that's one of the reasons that industrial is unknown. And when I went to the Podolskis for that first interview, it's the reason I didn't have any idea what an industrial building was or what an industrial tenant might do.
Yeah, that's a great point. They tend to be kind of like situated amongst themselves in industrial parks and in areas where a lot of people probably don't travel very often or don't go to very often. So yeah, that's a great point. And so it's kind of off the beaten path, let's say, and people don't see it. And so it kind of builds even more of a, let's say, a disconnectedness that maybe a lot of retail investors have with this asset class.
Did you know that there are about 2,000 streets around the United States called Industrial Drive? By the way, nobody names Industrial Drive. Those are the old areas because in the 60s, when they first started developing industrial buildings, it made sense. It was the Industrial Drive. but today they have different names. They're very fancy names like Swan Lake. So instead of being a straight street with a bunch of buildings up and down this grid, they have curvy streets, they have ponds. It's a whole new thing. It's a business park now.
Yes, exactly. Business parks. Yeah. Or I've even heard a lot of the phrase industrial park used. But you're right. So does Brick Properties, do you guys focus on manufacturing? Is that kind of like where you focus within the industrial class?
About half and half. We have a lot of manufacturers and they're fascinating. So you want to hear a few of the tenants we have?
Please. Yeah.
Okay. We have a company that's owned by, this is interesting, a divorced husband and wife. A lot of these companies have a backstory. They all have a backstory. Many of them are family businesses. They make exhibits for children's museums all over the world. So it's a metal shop and a wood shop. You wouldn't think of it if you were to take your kid to a museum where they have these exhibits where interactive, playing with water and sand or climbing around. These are made somewhere. They're made in our building. So it's a crazy business. I didn't even know it existed until I met them. We had another interesting tenant come along. You watch Shark Tank?
I have from time to time. Yeah.
Well, we have someone in one of our buildings, a company called Element Bars, and they make custom protein bars. Any ingredients you want and any packaging you want. The guy was on season 1 of Shark Tank. He got a deal with Kevin Harrington, and then I understand they never signed it. In his first year, I believe that he told them on TV he was doing $50,000 in revenue. And today he occupies a 50,000 square foot building with dozens of employees in our building. I think he does, I'm not sure I can even tell you the exact amount because I think it's confidential, but millions of dollars of volume making these protein bars. And every story is different and every family is different. These are family businesses for the most part. We're dealing with second and third generation owners. And what's great about manufacturing companies is they're called sticky tenants. They stay and they stay and they stay. We've owned certain buildings for as long as 30 years and some for 15 years. In some cases, the tenant sold us the building and remained there. And we've got a couple tenants who've been in our buildings for 18 years and 15 years. Having a manufacturer is great. I hope they're not watching this because I'm about to say something that, hi tenants, the rent goes up every year. And the longer they stay, the more consistent it is that the rent goes up and the rents in industrial buildings climb. We've got annual escalators. So we don't have to worry about releasing it every year. They just stay and stay. Sometimes they stay for 5 years and then they want to renew and they stay for another 5 years. It's usually 5-year increments, but they call and they say, hey, our lease is coming up. We'd like to stick around. Let's negotiate a new lease.
Yeah. And that's a great point to mention about manufacturing is people sometimes don't understand that a lot of these manufacturing operations use very sophisticated, very intricate type of equipment. That equipment, literally is assembled on site. It's not brought in through the front door. There's a lot of power requirements, so there's a lot of particulars. And so when you mentioned about being sticky tenants, they're there for a reason. And usually there's a lot of capital improvements like cranes, for example, materials handling equipment as well. That's probably been put in and installed inside the facility. And so these types of things tend to keep the tenants there for long periods of time. And I assume that that's what you mean by when you say that they're sticky, correct?
You're exactly right. We have a building in a town called Franklin Park, which is right up against O'Hare Airport, right in the heavy industrial area. When I say heavy, there's no real heavy industrial like steel mills, but the building that we have there is 100,000 square feet. And we have a tenant that's called Viking Materials. And what they do is they take giant rolls of steel that are delivered on flatbed trucks. They put them into a very sophisticated machine and they're chopped up into plates. So now what used to be a metal roll is now a stack of sheets of metal. And they have cranes covering the entire building. And they're 20-ton and 30-ton cranes that have a big hook that pick up these giant heavy pallets loaded with steel. and they sell them to manufacturers who don't want to buy giant rolls. They can't afford to have a machine that cuts them into plates. And these guys are in Minnesota and they're in Chicago. Very interesting thing. Viking occupies the building that was previously occupied by their number one competitor. When we bought the building, we leased it to the same kind of company. And then when that lease was up, that company moved to a different building. They grew and they didn't fit anymore. And this is a good one. We literally went knocking on doors in the neighborhood and knocked on the door of Viking, went inside and talked to the guy that was managing that operation and said, would you consider moving? Because I was looking for another crane user and I kind of knew they were in the same business. He said, how did you know? I said, how did I know what? How did you know we're looking to move? I said, I didn't know. He said, did you know that they're tearing our building down and making a new ramp onto the tollway, the tri-state tollway? I said, I did not know that, but shame on me. I should have known that. So I said, well, I have a building that is occupied by your competitor and he's moving out. They said, can we go see it today? I said, I think so. So I called up and I talked to Oscar Winsky, the company that was there. And they said, no, we will not let them in. They're our competitor. I said, well, how am I ever going to show them the building? He said, that's your problem. They cannot come in because all of our customers are shown on tags on our pallets of sheets of metal. It was a real problem. We figured out what to do. We actually had them cover up all their customer tags. And it took them a few weeks to actually do this. And then we got Viking to look at it and they had to sign a confidentiality agreement and promise they wouldn't steal customers if they saw something. I don't know how you make sure that that doesn't happen, but that's what these buildings are. They're set up for manufacturing for a certain type of operation. And they seem to continue to find those kinds of users when they become available.
Yeah, for sure. And so you guys when you mentioned a little earlier, 50-50, you're talking 50% manufacturing and 50% warehouse and distribution, I assume. Is that kind of your split in terms of the properties you guys?
Yeah, that's our split.
Yeah. And you guys are at this point focused exclusively in the Chicago area. Is there a particular reason for that?
Well, Warren Buffett has a comment that he makes all the time, which is the circle of competence is most important in any business. And I believe that he's right. We have owned buildings in other cities. We had a building in New York. We had a couple in Florida. We had one in Ohio. And I can tell you from experience that knowing your market in real estate, particularly in industrial real estate, because it's a very closed market. There's 20,000 industrial companies in the Chicago area, 1,300,000,000 square feet of industrial properties. There's enough here for us to do. And because I've been in this market for about 40 years, I can tell you almost with precision, if you tell me an address, I can tell you who's in the building and I can tell you what color the bricks are. Knowing the market that well gives us an edge because when we buy a building, we know what it should be worth. We know what the owner thinks it's worth when he tells us. We know what the spread is. It's hard to take advantage of somebody who knows their market so well that they just know it cold. That's what Chicago is for us.
Gotcha. So basically you guys are, you've developed a hyper-focused expertise in the Chicago area when it comes to industrial real estate then.
I couldn't have said it better. Exactly.
Yeah, that's exactly what it sounds like to me. So that's great. And the circle of competence, that's a great way of describing it as well too. A lot of industrial buildings and industrial real estate involves single tenants. And, there are some investors, mainly perhaps more on the retail side, that kind of see that as bringing excessive risk because you have only one tenant. And that a lot of that may stem from the mindset of retail investors, again, like we talked about a few minutes ago, who are primarily focused on investing in, let's say, like multifamily, where they're used to seeing dozens, if not hundreds of units in a particular complex. And so they kind of see, okay, well, when tenants are moving out, there's all these other tenants that are staying put. And so I have some, I'm cushioned, from, loss of income that I may experience when somebody moves out, let's say. So what do you think about that kind of mentality that, some investors may have, where they see single tenant industrial as being, carrying too much risk? And what do you guys do to kind of mitigate for that risk of when you have a building that's catered to a single tenant?
Well, first of all, you're completely right. That is a concern of many investors who are not familiar with industrial. And there are trade-offs. And one of the trade-offs is that the industrial business, particularly the end we're in, which is the B and C industrial, the returns are better. The trade-off is there's more risk and there's more return. So I can tell you that when you talk about cap rates, cap rate compression has just brought cap rates down to such a low level that I can't even understand why anybody would buy an apartment building today or an apartment complex. I can't fathom investing in a deal that throws off a 5% return. The difference is that industrial buildings, particularly in our niche, are generating 50% more return. So we're talking about somewhere in the neighborhood of 7, 8, and sometimes even 9% returns. And yes, there is that risk of vacancy. I definitely understand when somebody tells me that they're uncomfortable with it. And my answer to them is, don't put all your money in one industrial building. We have 17. We can give you diversification within our niche, within our circle of competence. We can tell you how to invest. Let's say someone's investing $500,000. I would suggest they go into 10 industrial buildings. Now, if you're buying the whole building yourself, it's a different story. But if you're an investor in a syndication, 1, 2, 3, 4, 5, 6, 7, they're like a series. And that's what I think people benefit from the most and still get the higher return. Another thing, by the way, is the fact that our leases do continue and do escalate. With an apartment, there are people who stay there forever. I'm sure you've got the little old lady who has been there for the whole 30 years that the complex has been built. But in most cases, leases come up, a couple or a single person or a family is in an apartment and they're not there forever. I can tell you that as I think through each of our 17 properties, we do have 3 multi-tenant properties that have 3 tenants each. That does help to mitigate the risk, but we are not in the multi-tenant industrial building business. It's a different business, and we have a different exit strategy that is counterintuitive, that you would not believe. When you hear this, you're going to say, really? I never would have thought that. We sell buildings to users. So what happens is there's a manufacturer making magnets, and he's in a building that's 50,000 square feet. And we own the building next door, and it's 30,000 square feet. The tenant's lease comes up, and the tenant's moving out. Most people would be scared to death. I'm about to have a vacancy. But what I know is that someone in the neighborhood that is in a building that doesn't want to move, but wants to be walking distance for what we call plant number 2 or warehouse number 2, they're a buyer. And for them, it's a tool for their business. So if we were receiving, let's say, a $5 a foot rent from the tenant that was leaving that 30,000 square foot building, that's $150,000 a year. If you look at it and sell it for a cap rate, let's say 8%, it's worth right around $2 million. I could sell it to the next door neighbor manufacturing magnets for $3 million. Reason? Moving would cost him $2 million. He needs the building. He must have it. He has no choice. If the building next door comes available, he's going to buy it. So if I renew the lease, that's better because we like to keep buildings and achieve cash flow. But it's incredible, the user market for industrial, for the B and C stuff under 100,000 square feet, prices are outrageous. People ask all the time, how did you get that price? If you had sold it with the tenant, you would have gotten $1 million less. And that's our secret sauce, is that we know the users and we know the brokers. And when a building comes available, We advertise it for lease and for sale. And when the sale comes, it's almost always an outrageous number that we can't believe. Appraisers can't believe it. So that's one of the great edges that we have. We had a building in New York. We bought it for $3 million, leased it for 13 years. It was 15 years. The tenant left early. We put it on the market and sold it to a user for $6.4 million. I couldn't believe it. Just couldn't believe it. The user had to have it. He was a guy in the area making medical tests. Now he makes tests for COVID. It was just sort of pro forma example of what happens with the user sale. So yes, there are risks associated with a single tenant building, but there are benefits because you can't sell an apartment complex to a user.
That's a good point. That's a good point. And I guess it kind of, to me, it also sounds like it kind of is interconnected with the stickiness as well too, right? You've got someone who's been in a particular facility or an area or in a building. They themselves can't leave or don't want to leave. But at the same time, if they need to expand and they need a larger footprint for their manufacturing operation, or maybe they have manufacturing and they want an adjacent facility for the warehousing and distribution part of it, perhaps, then now they're compelled to look in their immediate area. So that also kind of, in a way, kind of plays on the stickiness that we talked about.
Yeah, it's a phenomenon that doesn't exist in any other business. There's no other area of real estate that's like this.
Yeah, definitely. And so what do you guys do specifically in terms of trying to mitigate that risk of a single tenant? Is there some type of due diligence or some type of accessibility or evaluation process you guys go through when evaluating tenants?
Again, I think you're going to think this might be counterintuitive, but I hate debt. The reason I hate debt is because I've been through 4 cycles. And in my business, I know that when there's a cycle, it's possible that there might not be a user who's ready to buy a building down the street, or there may not be a tenant. And the secret to I think, staying power, which is a really important concept in our business, is to have very, very low debt. Our average loan to value ratio is 30%. No one's ever heard of that before. People say, hey, it's real estate. You should borrow as much as you can. In 2007, I had 2 close friends who were both in our business, and they were incredibly successful, much more successful than I was. They were driving fancy cars and living in fancy houses. And my lifestyle wasn't quite there because I'm in the get rich slow business. And apparently they were in the get rich fast business because they had a lot of debt. So they had a lot more assets than we had, and our debt was low. So I had an argument on the driveway. One of these guys, I walked by his house and he said, hey, come here. He said, I think you're crazy. You should borrow as much as you can. And I said, I don't think so. He went bankrupt in 2009, couldn't pay back the banks. Our debt levels were low enough that even though it was difficult, we went through some very difficult times. Literally, I went into a depression because I thought that I had lost a lot of money of my investors. I had 200 investors, and I felt like the banks are going to come get us. But we really persevered and stayed with the course, and we kept going. And I think if I had more debt, I would have been just as bankrupt as my friend. Interestingly, the other friend who was also telling me, take as much debt as you can, he went bankrupt as well. And one of the very funny facts is both of them used the same bankruptcy lawyer, whose family was one of my investors. Kind of a funny coincidence. I felt terrible for those guys. It was such a struggle. I felt terrible for us. It was a struggle for us too.
Yeah.
But the low debt is the answer. And it's not for everybody. Some people say, if you can't give me giant returns based on today's low interest rates, I don't want to do it. And my answer is, that's too much of a gamble for me, because interest rates may not always be low, and we're in industrial and the returns are higher, but you're going to take a little bit less in terms of leverage because we're going to have less leverage, and we're going to have a better level of mitigation of risk than other people in our industry, because I've been through it. And I don't want to have a situation where I put my investors' money at risk. We used to have higher debt ratios. We were up at 60%, which I thought was extremely low because a lot of people like 80%. But we paid a lot of our mortgages down, and anything we buy now, I'm strictly maximum 30%.
Wow, that definitely is that is by far on the lower end of the leverage scale in real estate. And like you said, many others are 2 to 2.5 times that. Always trying to push the limits as much as they can on the leverage side, because like you said, that's going to affect the returns on the back end. So it's a much different philosophy for sure, but definitely one that is more geared for wealth preservation than the actual, let's say, earning something on your capital. Because like you said, you've been through 4 different downturns, and obviously this is born out of those downturns.
And I've got an interesting situation that I think would maybe shed some light on this. Companies that occupy their own buildings, that own the buildings and have the operations inside, which are not well, they're investors in that they probably own the building personally and lease it to their company. Those companies, generally speaking, if they're very wealthy people, oftentimes they have no debt. So what I have found is that you don't have to leverage up to be rich. In fact, leveraging up to me is very similar to entering into the casino. I'm just not interested in that. And there are enough people who invest with us when I tell them, if you want to go high risk and you want to go high debt, you probably belong in residential where there's a lot of units, because then your risk is mitigated in a different way. Maybe shopping centers, maybe big box with big credit. But in my business, it's different. I have a lot of entrepreneurial tenants. And so I have to take a different approach to mitigate my risk. It doesn't mean it's right for everybody. So what I tell our investors is, potential investors and existing investors thinking of going into additional deals, is it's not for everybody. It's my philosophy, and I'm sorry if you don't like it. You should do something else, and I wish you good luck.
Yeah, great points. And what would you suggest for investors who are either already investing or looking to invest in industrial for maybe the first time, or maybe they've done a deal or two? What would you suggest are kind of key things that they should look for as part of their due diligence?
There's one thing. Industrial is controlled almost everywhere in the world by industrial brokers. There is an organization called the Society of Industrial and Office Realtors. In order to qualify to be a member of this organization, a broker has to have 5 years of experience and have done millions and millions and millions of dollars of leases and sales. In every major city, and even in some remote areas, they're called SIOR. I'm a member of the organization. I've been part of this organization for 30 years. You find an industrial broker who's a member of SIOR, and you get the broker to the building, and you say to that broker, I'll pay you, I'll take you to lunch, I'll do whatever it takes, but can you please share your thoughts on what's good and bad about this building and this location? Fill me in on the real estate tax risk, fill me in on what values are up and down the streets and what the vacancy is. The SIORs know all this. And I would advise anyone even looking to invest with me to talk to another SIOR in Chicago and say, do you know this, Joel? And everybody knows me. I've been around too long not to be known. And, some people have an opinion that I'm kind of a tough negotiator, or I don't let buildings go easily. I hold on to them, and I'm not much of a seller. So people will the brokers give their honest opinions, and they'll be mixed. Some will say, if you invest with Joel, you might be investing for life. And chances are that's true. But they'll give an honest opinion about the value and what the upside is. And also our capabilities as an operator, because I think that the operator, the manager, the asset manager, and the property manager matters a lot, because a well-managed industrial property will outperform a badly managed property, unless the next door neighbor wants it, in which case it always works.
Yeah, that's a great point. In fact, I'd never even heard of the SIOR, so that's pretty interesting that you bring that up. And you said that this is a national society, then so there are
It's
brokers in all major
international.
markets?
It's international.
International, okay.
Yeah.
And so like if someone's looking to do some due diligence, they can contact or find, someone who's already accredited with the SIOR in their local market?
Yeah, the thing to do is to call the SIOR national office in Washington, D.C., and I'll give you the list of the local brokers who are SIORs. Although I can tell you that there are also 11 major firms that do brokerage for industrial properties, and almost all of them in a big city have a few SIORs. I would refer to like CBRE, JLL, Cushman and Wakefield. My brother, who used to be in business with me before we sold our brokerage company, I started and sold the brokerage company. My brother, David, runs the Chicago industrial office of Cushman and Wakefield and has about 30 industrial brokers, of whom about a third of them are SIORs. My brother's an SIOR. So if you want information about my buildings, call my brother. He'll give you an honest answer.
Will do. And so what about on your end? Like, what are you guys looking for in terms of when you're evaluating a potential opportunity that you may want to syndicate? And sure, you're out there evaluating whether or not this is an industrial property that you perhaps want to bring into your portfolio, other than the low leverage aspect, which is probably something that's inherent to every one of your assets. What kind of main things are you guys looking for checklist wise?
So there are two factors. Number one is location, which is always something that's on everybody's mind in real estate investing. The second one is geometry. Geometry means how is the building laid out on the site? Because the key to industrial success is parking. In the 1960s, when buildings were originally built in industrial parks, the parking ratio that was believed to be appropriate was 1 car per 1,000 square feet of building. And what happened was, as companies grew, they didn't think through the fact that they were going to add more employees, both in the warehouse or the manufacturing and in the office. And every building built in the 1960s, unless there was expansion land included when they bought it, is short on parking. Today, the very minimum parking requirement is 1.5 cars per 1,000 square feet. So the geometry of the site in the building is really critical. There are two other factors in the geometry. The geometry of height. The ceiling height matters. If a building has a 24-foot clear ceiling, the value is significantly higher than if a building has a 12-foot high ceiling. Because for warehousing product, even a manufacturer uses cubic footage to stack product in racks or on top of each other. And so the geometry of height is extremely important. Years ago, buildings were built at 18-foot clear and it seemed high. Today, double that, 36 feet. And there are buildings that are higher than that. Amazon takes buildings that have 40, 42 feet clear. So that's the second part of geometry. And the third part of geometry is how the truck docks work. An industrial building without good truck docks is useless. So where the trucks are located and how the trucks maneuver on the site and how they back in and out of the docks, and even in fact, sometimes where they wait, if there are trucks in the dock and there are deliveries or pickups and trucks sitting outside, they can't just crowd the street. The street is not a good place for trucks to be lined up. You probably, if you've been in an industrial park, you've seen trucks lined up. It means there's bad geometry with someone's docks. And in the most modern buildings, trailer parking is critical. That's another part of geometry. There's nowhere for the trucks to go to be stored for the trailers. And so today, the most sophisticated investors are paving with concrete enough land to hold a tremendous number of trailers. And that could be the difference between one building and another being desirable to someone like Target or Amazon. So I can't stress enough how important geometry is. We look at the site plan and we consider that far more important than the floor plan.
Yeah, those are great points. And in fact, I kind of liken the whole parking ratio to what you see a lot of times in multifamily complexes where, older complexes will have a certain number of parking stalls, whether it be like a carport or open parking, however way they've laid it out. But, the parking ratio of even older multifamily is different than what it is in newer buildings. Of course, now even that's shifting because in some urban areas, right, there's this expectation now that people are going to be using bicycles or electric scooters or whatnot. And so it's almost kind of reverting back in the other direction. But generally speaking, newer multifamily complexes will have more parking available than older buildings. And the same thing also on the industrial side, for sure. And it's also interesting that you mentioned about the clear heights as well, too. Clear heights now are basically pushing, 40 feet and higher. And just in the last, I think is it maybe 2-3 years now, where we actually have the first multi-story warehouse that's been constructed in the United States. And I think that was a Prologis project, but so now we're starting to even see multi-story as well too. And although multi-story has been around in Europe and in Asia for quite some time, we're now starting to see that in the States as well. So for people that are listening to this and haven't heard some of these things before, I think this is all kind of really, this should, if it's not already, kind of really hitting home the demand for industrial real estate that's out there in the marketplace.
It's hot. It's really hot. I've never seen anything like this in 40 years. Every time a Macy's closes, a warehouse pops up because that product has to be someplace. And instead of being picked up on a rack in a store, it's delivered from a warehouse. And it's true that our country is changing in terms of manufacturing. We as a country do not want to be reliant on certain countries where a lot of products are made, like China. And there's something called reshoring, which is where companies have figured out that they better be making some of their product here because of geopolitical risk. So there's just huge demand. And industrial, if you read any of the periodicals online or otherwise, it talks about how industrial's the hot sector of our time, and it's driven up the prices. It's been difficult for us. It makes it hard for us to buy properties because we're competing with everybody now who likes industrial. So we have to work harder and work smarter to find good deals. They're not as plentiful.
Yeah, for sure. And just to kind of add to what you just mentioned, for investors that probably aren't very familiar with industrial, they should also know that the footprint needed for logistics and industrial for like an e-commerce retailer is, I think, about 3 times that of like a traditional retail outlet. And so, like you said, every time a Macy's closes, that creates demand for industrial. Well, it actually creates almost 3 times more demand for industrial. So it's actually a multiplier effect. It's not like a 1-to-1. So that's something for investors to kind of keep in mind as we kind of go through this constant, or this continual, I should say, rise in e-commerce growth moving forward. And the other thing that I would probably mention as well, too, like you said, is the whole reshoring. And so the whole, manufacturing coming back to the United States. I mean, even if that slows down, because now with the change in, the political environment in the United States now, there's other factors contributing to the reshoring, or perhaps even just nearshoring, bringing, manufacturing either closer to Mexico or somewhere close to North America, and the demand that's creating. And one of the things that happened as a result of the pandemic was the more supply chains that were disrupted. And when these supply chain disruptions took place, key suppliers, key raw materials, all these things, or various things that manufacturers experienced. And so that kind of contributed to where a lot of companies now are figuring out how resilient of a supply chain do I want to have? And and of course, the more resilient you want to have, the more you're eventually going to have to pay for either key ingredients or key raw materials or unfinished products or whatever it happens to be. And all these things ultimately are going to increase the demand for industrial. So that's something else I think investors or people who are eyeing this sector should keep in mind. And when you look at some of the rent projections, I've seen on some of the brokerage reports now, in some markets, I mean, they're projecting a 5-year rent increases of well over 30%. I mean, it's it's truly remarkable.
It is. I find that the demand is almost insatiable. I have a direct line to all of the brokers in the Chicago area who specialize in industrial. We all communicate with each other via various different systems that keep us in touch. And we have something called wants and needs. And I would say on an average day, I get maybe 40 or 50 wants or needs from other brokers representing tenants and buyers who need industrial buildings and can't find them. It's just, it's something I've never seen before. And there's been more speculative buildings built over just the past few years, hundreds of millions of square feet in Chicago. And there still isn't enough space. And users can't find buildings to buy. They are very frustrated. They would love to buy and own, especially in the environment today of 3.5% interest rates. But they can't find anything and they end up leasing because they can't do it. There's nothing. It's great. Yeah. It's great.
It really is. It really is. And I'm sure we're going to see quite a bit of cap rate compression in the industrial space moving forward as well. So one of the things on the topic of like investors that's kind of unique that you guys offer, I guess, is a Dutch auction. And it's certainly new to me, and I'm sure a lot of listeners as well too. Can you kind of explain what a Dutch auction is and how it works and how it benefits investors?
Sure. A Dutch auction is it's a procedure where investors make bids to buy something, and it's sort of like a sealed bid situation. Let me first of all tell you why we did this. Because we're long-term holders, we have investors who've been with us for a long time, and we have, unfortunately, what I call widows and orphans, which are adult children of people that were my original partners years ago. And sometimes they and others have a change in their financial situation or in their estate. And over the years, they've come to me and they've said, "Hey, Joel, we've been in this deal with you for 10 years. We'd like to get out." And I had no mechanism to get them out other than to introduce them to some investor who might be interested in buying their share of the deal. And one of the investors had invested about $1 million with us, and it was meaningful to him. And he said, "How do I get out of this in a fair way where I don't get taken advantage of?" I did a little research, and one of the young guys in my office said, "Why don't we do a Dutch auction? That's how treasuries are sold for the United States to raise money, where people make bids, and the bid system works in a very specific way where it's fair. It's fair and it's appropriate because nobody can influence the price, because there's a group of buyers that are out there looking to buy from a group of sellers of syndicated equity." So we came up with a program, and we came up with documentation, and we came up with forms. We had a bidder form and a seller form, and we ended up with about $1,700,000 worth of ownership shares owned by people that wanted to sell. And we gave all the information about each property to all of our investors and outsiders to try to help get a higher price for the sellers. And then we made a chart showing what the yield would be based on certain prices with certain discounts, 10%, 20% discount. And we ended up getting these forms given to us by people who like this kind of property, and they made bids at say 10%, 20% discounts. And what happens ultimately is that there is something called a strike price, which is the price for any property that it takes to buy all of the available equity that sellers are trying to dispose of. And we ended up getting 11 new investors and a number of existing investors who bought out investors who wanted to leave. And the process was impeccable. I didn't run it. It was a 25-year-old young man who's better with the computer and those kinds of things. And he established a software program to do this. And I think everyone who got bought out felt it was a really fair process. They felt they got a fair number based on no influence by anybody. And at the very end, when we came up with what the price was that each potential seller was going to receive, we gave them the option to opt out. We said, if you don't like the price, you can keep it. And a few opted out, and the majority did sell. And it's really interesting. I ran into the $1 million seller. He did sell all of his equity in our deals. He was investing in his son's residential developments, and he needed the money, I think, for that. He wanted the money for that. I ran into him at a grocery store about 6 months ago with his wife. They were wearing their COVID masks. And he said, honey, come here. This is Joel. He's the guy that did that really, really fair thing that got me out of their investments in a way that I thought was incredible. And the wife said, oh, hi, Joel, I'm Christine. And John's been raving about your program to get him out. He thought it was so fair. And I said, oh, glad it worked. And I called Austin, the young man that put it together. I said, oh, I just got the greatest compliment from John and Christine. We're going to do it again because it's a way to create liquidity in an illiquid product. But it's a lot of work. But I think it's a nice thing to do for the investors to get them out in a fair way if they don't want to stay in.
Yeah, that's great. And like you said, and that's one of the things that kind of holds back individuals from just even investing in syndications is sometimes these deals have, hold periods of 7 to 10 years or more. And so that's something that kind of holds people back, from investing is they say, well, what if I need the money? There's no way for me to get out. And granted, I don't need the money now and I'm fine, but you never know. There could be something that happens, some type of life event or something, and I may need the money, and I'll essentially feel trapped at that point, in the investment. So the fact that you offer that to the investors and a potential avenue for them to exit, I think that's a great thing.
Yeah, thanks. We're really proud of it.
Yeah, definitely, and I think that just further encourages investors, to take the plunge and to invest. Knowing that there's a potential avenue in, the Dutch auction, arrangement. And is that something that you do on a periodic basis? Is it like once a year, every 6 months, or you just do it as need be?
It's a big job, and our plan is every 3 years. So we did it in 2019. So we're due again this coming year. But I want to give you a warning about this. I thought about maybe going into the Dutch auction business. I thought this was so incredible. I'm going to go to other syndicators and say, how would you like to be in a Dutch auction with your investors? And I can help the ones who want to get out and the ones who might want to get in, and I can open it up and introduce you to new people. Every single one said no. Here's what they said. We want to let our sleeping dogs lie. When you advertise to 200 investors that they can get out, it's different than if you leave them alone and keep sending them quarterly distribution checks. I don't want to open it up to that. And I tried maybe 5 or 6 different people that I know pretty well. And I said, but this is such a great thing to get your people out. No. You do it. You do it. So it means taking a certain level of risk. It means opening things up and giving people information that otherwise might not be available to them. So we feel like it's unique to us, except if someone else wants to do it for themselves. I would say if you asked 100 syndicators if they would do a Dutch auction, maybe 1 or 2, when they understood it, might do it. But the others, I think it's a difficult pill to swallow, because it really is, it creates a level of transparency that, I'm not saying that they're against transparency. I'm saying it just increases transparency to being on steroids in order to do it properly.
Yeah, that's a great point. And I guess your hold periods tend to be quite a bit longer than probably a lot of other syndicators as well. So perhaps maybe something that offers you or brings a benefit, for your syndication deals to investors, the fact that this is something that, can be done, on every 3-year cycle, I guess.
I love it when I send the package that we send out to the investors and I say, this is our Dutch auction. We're going to do this every 3 years if you want to get out. And they look at it and they say, I've never seen anything like this. Why don't you get all the other guys to do it? I said, I tried. It didn't work. So.
Yeah. Well, Joel, how can people find out more about you and Brit Properties?
On the internet, Brit Properties. There's one T in Brit. We also are under Brit Assets. So it's britassets.com, britproperties.com. And we have all of our information on the website as to how to reach us, phone numbers. We're available to talk to our existing investors and prospective investors and tenants. If any of our tenants watch this, thank you guys. It's nice having you.
Well, thank you, Joel. Thank you for coming on the show today. I really enjoyed our time. Like I mentioned in the beginning, industrial real estate is one of my favorite sectors of commercial real estate, and I could talk on and on. So we're gonna have to put a cap on this, but maybe we can have you on again at some point to talk maybe a more focused discussion on something with regards to industrial. But thank you for coming on today and providing a ton of value to the audience.
Thank you, Mo.
Yeah. So that's all for today. I thank you for tuning in.
Thank you for tuning in to this week's show. If you are interested in learning how alternative investments can help you build purpose-driven wealth, sign up on the High Rise Capital website to receive our monthly newsletter and free investor ebook. Lastly, if you enjoyed this episode, don't forget to subscribe and leave a 5-star review. Thank you for listening to Purpose Driven Wealth, the podcast for empowered investors.